But for me, I would just add that first of all, what the law tried to do in this reform is to tighten. I mean, the whole concept of residency for individuals didn't change. Uh, all right, there was no significant, there's no change at all around the definition of residency. Residency still remains, of course, why it's 3 days. That is the basic. Um, I'll call a basic indicator, right? Because there are other things that actually are used to determine, especially in international taxation, when you have to do with somebody having dual residency, then we'll begin to look at other factors that include habitual abode. Where do you habitually stay, right? That could be also used to determine where your residency is, even if you're trying to beat the 1 to 3 days concepts, right? Again, we're looking at where do you have your principal, abode, right? Where do you have a principal? Where do you have what they will call in immigration, what they call ties, right? Where do you have tie, strong tie? So that could also be used to determine where you actually should pay your tax. So it's not necessarily the issue of number of days. It's not just restricted to number of days. But like I said, there's not much that changed around the definition of residency for individuals. Okay, but again, there's also an effort to make sure that there's a link between the charging provision. Of course, we talked about the incomes to be subjected to tax, and to the other aspect of the reform. For example, there's now increased focus on substance rather than just what you declared or what you presented. So there's going to be more focus on substance. For example, government will now be looking at even third-party confirmations. For example, exchange of information is also there. So there's a link between the exchange of information between the country where you are living or where you are currently based and where you're from. So your nationality. So there's a link. There's a strong focus now on exchange of information between these jurisdictions. And Nigeria actually interestingly belongs to a number of these, both bilaterally and even multilaterally. We belong to a number of corporations that have been established for the purpose of exchange of information. So I can actually write to a country, even if we don't have a bilateral agreement or treaty, or call it double tax treaty, even if we don't have a double tax treaty with them, I can actually kind of leverage on other treaties that are multilateral in nature. Tax information exchange agreement is also there, where we can explore and get information about that particular individual or corporate entity. So now there's a lot more focus on transparency, because this is talking about transparency. There's the days of saying, okay, I mean, government is not able to see what I'm doing out there, so I'm just going to declare what I want to declare, has actually passed. So and if you look at there's a very concerted effort to align the tax administration generally, to what the OECD has referred to as tax administration 3.0. So we're now moving to 3.0, whereby government is not just going to sit back and watch you declare. Remember, before now, what we operated was a government assessment. What I mean by government? Government is the one that determines what you pay as tax. And this was like way back before. Globally, there was a shift, and then there was a move towards self-assessment, meaning that okay, government will trust you to self-assess yourself and then file your, pay your tax and file your returns. So, but because of the increase in tax evasion and global tax avoidance, so government is shifting away from that to say, okay, now we need to even look beyond just, we need to move beyond just waiting for you to declare. We want to be involved in what you are doing. And that's what is leading to, take for example, the case of the e-invoicing we're talking about today. Government wants to be involved in your business directly by plugging in technology, an API into your invoicing system, right? Such that they can see what you are doing as at the time you are saying on real-time online basis. So that's transparency in this case now. So we're no longer, there's not going to be, it's no longer the time you say I'm hiding, you're going to hide your income, and whether or not I declare it or I repatriate them into Nigeria, I will be out of the hook. So now government is saying that even if you don't declare them, right, And it's all about information. And they say, get information, they gather information that you have this income, you're earning, but you're not bringing them forth. It's going to be also this tax in you as though you have declared them, right? So that is also, of course, I mean, there's a lot of development around this area. There's a CFC rule, government also implemented for companies. Companies that, for example, that have, let's say, headquarters in Nigeria and they have subsidiaries in other countries, especially the tax havens. Jurisdictions we refer to as tax haven. So what most multinationals do is to set up subsidiaries in those jurisdictions. And remember, those subsidiaries in those jurisdictions, they're supposed to declare dividend and then repatriate the dividend to Nigeria for the this is where the shareholder sits. Then again, but because the shareholders want to, the high net worth individual who are the shareholders want to manage their tax exposure, they would rather leave the money there, in the tax haven, right? So it's not taxed in the tax haven, it's not taxed in Nigeria. That's what we call double non-taxation. So we now move away from double taxation to double non-taxation. So now that is what the CFC rule is now addressing, to say, look, regardless of whether you brought the money back to Nigeria or not, it will be taxed in the hand of the Nigerian multinational at head office, as though that money has been brought back, right? Especially where there's no evidence that if that dividend is distributed, there's not going to cause any harm to the subsidiary. So once that is proved, of course, it will be taxed in the hand of the head office, especially with respect to passive income. This is specifically to passive income, right? Passive income, we're talking about interest you earn on loan, we're talking about rent from immovable assets you have, we're talking about royalties you earn from intellectual properties. For example, the content creators, the artists, all those that manage different labels and all of that. And any royalties for all of that. So whether or not those royalties were actually declared by you in Nigeria, as long as there's information that you're actually earning certain royalties from certain people using your intellectual property, that's the tax that's going, you've declared it. So that is just to bring out the aspect that government has brought into tighten all of these loose ends. Thank you.